Alright, welcome back. Today we have a really exciting video planned for you guys. We did a lot of videos on entrepreneurship a lot in the past, so I feel like we should switch our attention of focus now to investing, not only in stocks but also in index, mutual funds, or bonds. Just talk a little bit about them. Now, one of the first things we have to actually think about or actually contemplate on is the idea of Mr. Market, right? How does Mr. Market, or this character, or this analogy of Mr. Market, play a role in the investors role as a person that invests in the market? Now, today's analogy is pulled directly from Benjamin Graham's book, The Intelligent Investor, which is one of the most important and the most crucial books any investor should actually read before going into the stock market. As we all know, Benjamin Graham is the professor of Warren Buffett. At one time, Warren Buffett was the second most wealthy person on earth. So there's a lot of valuable investing tips and ideas, strategies that we could get abstract out of this book. Now, one of the most important or most memorable concepts that I picked up in this book was chapter 8, right, which is the analogy of Mr. Market, and how the investor has this relationship with Mr. Market throughout his investing journey, right? So now in this video we'll be talking about Mr. Market and some practical applications that Mr. Market has on the investor. So Mr. Market, let's go back to square one. What is Mr. Market? Now, Mr. Market is the analogy that Benjamin Graham has in his 1949 book, The Intelligent Investor. Now, Mr. Market is this, you can see him as this salesperson, right? He comes to you every day when the stock market opens. When the stock is open, he says, like, good morning, today I'm selling this stock for this much price. And you could pick and choose whether you want to buy, you want to sell, or you want to do nothing, right? And you judge your actions of whether or not you want to do any transaction at all with Mr. Market based on the intrinsic value that you view the stock as, right? So every day, Monday to Friday, except like holidays, like public holidays or like national holidays, Monday to Friday, Mr. Market comes to your door and knocks and says, good morning, I'm selling X shares in this company for Y amounts of dollars. Now, what you want to do as a person that is being approached by this Mr. Market, what you want to do is judge the intrinsic value of the stock, right? You look at the stock, you say, this company, I think, is a little bit overpriced for the price you're charging for today, so probably you will do nothing in this sort of scenario. And let me explain this better. Okay. So let's say you judge this company for one share. You say it's around, I will pay $50 for one share. Now, probably Monday, Mr. Market comes, he knocks on your door and says, I'm going to sell this one share of this company for, let's say, $70, right? Now, that's $20 above how much you anticipated to buy for this share in the company. So you'll just say to the Mr. Market, this is a little bit higher, so maybe I'll wait. So you do nothing on Monday. And Tuesday, the stock prices dropped a lot. It goes to $60. It's still a little bit higher, so you still do nothing. And it goes on probably the next Monday, Mr. Market comes back with a price of $35. Now, at this point, the stock or the share of this company, the value of this company has gone down a lot, almost half, right? So at this point, if you still view this company as valuable, if you still see this company as a good investment, whether it has good management or whatever, if you still think this company is a good investment, now that the prices are low and Mr. Market has given you this offer, you'll go in. You'll buy this stock, right? So a few lessons we could take out of Mr. Market's analogy is that you are a partner. You can see from this quote right here, from The Intelligent Investor, the book. The intelligent investor shouldn't ignore Mr. Market. Instead, you should do business with him, but only to the extent it serves you, your interest, right? So it's always your interest driven. You have to look at whether or not the prices fit your value of this company. If it's too high, you wait. If it's underpriced and you feel like it's worth higher, then you go in. This is the fundamental of value investing. You look for stocks that are underpriced in your opinion. You look for stocks that you think should be worth more or have really good potential in the future, right? You find these stocks and you locate them, and when Mr. Market comes with an optimal price, you actually go in and say, look, I think this is a good investment for me to do, and the prices look right, the company has great potential, whether it's the management or it's a good product or service, whatever it is, and you go in and says, yeah, this is a good investment, right? So right here, in his book, he also said that, in chapter 8 of this book, he also said that Mr. Market sometimes is really optimistic, while other times he's really grumpy, right? Sometimes he comes in really happy and shares up these prices at undervalued price. So that's when the market probably is going down a bit. So Mr. Market comes in and sells these shares undervalued. Other times, or other days, Mr. Market comes here and then sells these shares on overpriced. So you shouldn't be judging a company's value solely depending on the stock price. You should also be judging the company's value based on other factors, right? Now, to give a few examples of this, let's say you are looking to buy a coffee shop down on your street. So this old man, he runs a coffee shop, and you want to buy this business. Now, on probably January, you go up to him and say, hey, I'm interested in buying your business. I see that you're trying to retire now. Maybe I could take over. And then you ask the old man for his price. The old man may say, I'm going to sell my coffee business for $250,000. And you think to yourself, that's a little bit overpriced. For my estimations, or from my value of this coffee shop, if you value this coffee shop at $100,000 and this old man is selling it for $250,000, then that's overpriced for you, right? So you keep waiting, and probably five months after that, you go back and the old man said he really can't take the business anymore, and says, I'll sell for $150,000, right? And probably you'll say that's an okay price, and you'll go buy the business. Similarly, the whole story could still work in the stock market industry, right? You're still buying shares of a company. You're still buying shares of the company for X amount of dollars. So from this analogy, we can actually learn a few main things. We can learn that Mr. Market is your sort of like a partner. You look at him every day. He comes to you every day. You judge if the value is right, whether you should do buying or selling or not doing anything. So Mr. Market actually comes to you every day. So that's overall, that's what we could learn from this analogy, and actually some of the applications we could use. Alright, so that will be the end of this video. We'll also be making another video on a few ways we could invest $100 today as well. So today will be